Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Well, back home on the Lal Street, the market ended flat. The Nifty gave up the 10,800 mark in the last hour of trade, while the Sensex ended a tad bit below the 35,500 mark. The mid-cap index actually underperformed a tad bit yesterday to end the day 34 points lower. The Nifty Bank also ended flat with a tad bit of slight negative bias. But how the Q stacked for the day? Sonia joins us early this morning with more on that. Sonia, good morning. Over to you.
Hi Anisha, good morning. Thanks for that. Well, as you rightly pointed out, it's been a very narrow trading range that this market is hovering within, and there seems to be no trigger to take the market either on the upside or on the downside. So within this trading range of 10,680 on the downside to 10,850 on the upside, and even if you look at the global markets, yes, there was a bit of weakness the last few days, but last night we did see some recovery in the US markets. The trade concerns have now simmered a tad bit, so some green over there. Technology stocks have been doing quite well, but the risk for our market continues to remain on what's happening with crude. Brent crude once again has surged overnight. In fact, Brent crude, a very narrow trading range that this market is hovering within, and there seems to be no trigger to take the market either on the upside or on the downside. So within this trading range of 10,680 on the downside to 10,850 on the upside, and even if you look at the global markets, yes, there was a bit of weakness the last few days, but last night we did see some recovery in the US markets. The trade concerns have now simmered a tad bit, so some green over there. Technology stocks have been doing quite well, but the risk for our market continues to remain on what's happening with crude. Brent crude once again has surged overnight. In fact, Brent crude has now hit that $76 a barrel level, and we've seen US crude as well spike up on news that the US State Departments have now asked all companies to cut their oil imports from Iran to zero by November. So because of this geopolitical risk, we are seeing a huge spike up as far as crude is concerned. In fact, a couple of worrying points coming in. One, the RBI last evening did mention that the banking system continues to see a lot of stress as the gross NPA ratio has risen further. Remember, a lot of the banks put pressure on the markets yesterday as well, so that's something that could continue. And two, comments coming in from Credit Suisse where they say that emerging markets continue to see net foreign selling. In fact, in the last 5 months, we've seen $32 billion of selling from emerging markets. So in that context, there are some worrying signs for our markets, but all in all, seems like it will continue to be in this trading range.
All right, Sonia, trading range is what is expected. With that, what are the stocks you're watching out for today?
Well, there are a couple of stocks on my radar. Of course, banks, after what the RBI had to say with respect to worrying comments on NPAs, etc. Apart from that, Fortis, where the company has recorded a loss of more than 900 crores in this particular quarter. M&M had an analyst day yesterday, a farm equipment day, where they did talk about an 8 to 10% compounded annual growth for the tractor industry for the next 5 to 10 years. And a couple of stocks from on my list as far as brokerages are concerned. Biocon, HSBC has upgraded Biocon with a target price of 715. They now have a buy on the stock. Back to you.
Okay, Sonia, thank you so much for getting us that list. But it is time now for a quick break. Up next, the findings of Luthra and Luthra report in the Fortis case investigation is finally out. Key highlights on the other side.
Welcome back. You're watching Power Breakfast on CNBC TV 18. Now on to a CNBC TV 18 exclusive. The government has rejected 2 offers from private players to pick up stake in IDBI Bank. Sources in the government tell CNBC TV 18 that they feel selling stake in IDBI Bank to a private investor at this time will perhaps not get them the best value. Sapna Das is here with more. Sapna, take it away.
Well, sources have clearly told CNBC TV 18 that it is going to be LIC that may end up as the strategic investor in IDBI Bank. Having said that, sources have indicated that there has been a lot of interest from private players, from private investors. Possibly these could be banking companies, but as of now, the government is not very keen on looking on the private investors. because it fears that, they will be interested in picking up a stake in IDBI Bank at a very low cost. So this is the major concern of the government. Probably that's the reason why they may not be looking at private investors just yet. Having said that, the clear indication from sources is the fact that if you look at the balance sheet size of IDBI Bank, aside from the market cap of around 23 to 24,000 crores, they have assets worth real estate assets worth 7,000 odd crores. In terms of the non-core assets, investments in major companies around 7,000 odd crores. Expect better resolutions through the NCLT process. So all of this, basically, what they're trying to say is that this is indicating a turnaround in IDBI Bank's fortunes at some point in time. Keeping all of this in mind, probably it's a good idea to give the majority stake to LIC. It could be a good upside for LIC, probably also for the government, because the kind of modus operandi that is being looked at in terms of the stake dilution, the government shareholding can come down if the preference capital route is adopted by IDBI Bank, issuing to LIC. Thereby, the government shareholding will get diluted, not divested. So later on, there could also be a possibility of actual divestment happening in IDBI Bank as the valuations improve. This is a very clear indication coming from sources, top sources, and this is what it appears to be as of now. A quick last word. The plan also is to keep IDBI Bank as a subsidiary of LIC, probably just on the lines of LIC Housing Finance, with a proper professionally run board and stuff like that. This is where the matter ends as of now. We have to wait and watch and see how quickly the deal gets the nod.
Okay, sticking with that story then, think how to save a bank and not how to sell a bank. That's the message from former chairman of SEBI, M. Damodaran, to the government. Damodaran, who was also the former chairman of IDBI, believes that regulatory integrity will be compromised if LIC is allowed to buy majority stake in IDBI Bank. Hear him out and the other veterans as well about IDBI Bank's strategic stake sale option.
If LIC wants a bank, let it increase its shares in Corporation Bank by getting IRDA approval. It already has investment in Corporation Bank. It's the biggest investor for a long time after the government. Go and pick up that, and that bank isn't doing terribly well. Hasn't been doing well for quite some time. So to say that LIC will get this bank, which is going to be great for LIC, I think you're actually stretching the management bandwidth of LIC, not providing enough management bandwidth to the IDBI Bank, solving none of its problems, whether of personnel or asset quality or anything at all. And the government makes some money in the process.
With 100 crore equity, LIC, under government guarantee, with its solvency ratio being one of the lowest among the life insurers in the country, are you doing the right thing to LIC by asking them to buy another very equally sad case of IDBI Bank?
When we want to really look at how to get this system to work, I believe India could be the model for the banking world if you had government is a majority, not a majority owner, but the largest owner. Having 26% stake with everyone else having whatever 5 or 10% stake, so that you did not allow the bad private sector influences to come in, and you got rid of the governance issues and the HR issues which are there right now. That's the way to start building a system.
All right, even as the IDBI and the banking sector at large grapples with bad loans, things could get worse. The RBI's Financial Stability Report has warned that bad assets will cross the 12% mark by March next year. The RBI has also underlined that the current steps of NPA recognition will only mean short-term pain, and it will bring medium-term growth and stability. Lata joins us with her takeaways from this. Lata, take us through this Financial Stability Report, and what does this mean?
Oh, absolutely. A lot of people have been debating whether NPAs by the end of the current financial year will fall. A lot of people believe it won't. It will fall in FY20. But now the Oracle has spoken. It doesn't get more reliable than a Reserve Bank report which says, yes, it will rise. For the system as a whole, NPAs in the base case. I mean, in a stress case, it could be much worse. But the base case, it will rise to 12.2%. That is 60 basis points higher. If you only looked at the more affected, vulnerable part, which is the 11 banks which are under the prompt corrective action of the Reserve Bank, their gross NPLs, which now stand at 21%, could rise to 22.3%. So even in the most vulnerable cases, with all the protection and supervision of the Reserve Bank, it's actually going to get worse because a lot of unrecognized loans will become GNPAs. And for the 6 most affected public sector banks which are under PCA, even the capital will fall below the regulatory minimum, and therefore the government will have to capitalize them immediately. But then the RBI is coming to the various steps that have been taken. It says the bank recapitalization will solve the capital shortfall and also play a catalytical role in allowing loan growth. It also has a positive word to say about the prompt corrective action framework, which will ring fence the weak banks and prevent them from deteriorating further. It has a positive word on the February 12th circular, which will, it hopes, incentivize faster resolution. Of course, the IBC, which has also speeded up resolution. So the point that the regulatory and supervisory steps, which have come in for so much criticism, the PCA framework and the February 12th circular, it believes is short-term pain, but in the medium term will create stability. But the most important point is it has a word of disappointment on the lack of governance reforms in public sector banks. It both in the prelude and in the chapter on public sector banks, it says that governance reforms has taken a back seat, and if undertaken, it can improve financial reforms, financial stability, and reduce operational risks like the one we saw in Punjab National Bank.
Welcome back. Well, Fortis will be in focus today as details of Luthra and Luthra report are finally out. Also, the company has of FY18. Ekta is here with all the details. Ekta, good morning. What does the read-through suggest? And the auditors have not signed off the Q4 numbers.
Yes, well, a lot of developments to take in from what was a press release which came in at 4 a.m. So I think it deserves that much amount of time to actually go through it. But nonetheless, a couple of important takeaways from this is that the Luthra and Luthra report was submitted by the Fortis board. So that basically indicates that there have been ICDs or intercorporate deposits which were not given under normal treasury operations by the company. So it was not specifically authorized by the board of Fortis, and hence this is something which needs to be recovered from the management, or not from the management, from the promoters, and hence the board is undertaking legal steps to ensure to do that. So that is one thing where all the details of the ICD have come out with regards to the investigation, but they are going to be submitting these investigations into the SFIO as well as SEBI. Now, separately, they also released their Q4 numbers. It was a disappointing quarter for them because forget the loss of 900 crores plus. That was because of a write-off of over 800 odd crores. But it is the margins also which disappointed and came in at around 1% for the quarter, or a little over 1%. So that gives you an indication that there was operational difficulty in the company as well, and the revenue was down around 3.3%. So that's on the numbers. Plus, separately, like you mentioned, the auditor has not signed off on the Q4 and FY18 numbers. I went through the press release multiple times. There is no audit report which has come in from Deloitte. Interesting, because apparently all of the delays which have taken place in the numbers had to do with the additional information that the auditors were asking for. So I think that would be a key clincher that, why exactly haven't the auditors been satisfied with the information which was given to them despite all of the delays which have taken place. So I expect the stock to be in the red, and also it's in focus ahead of the final bids which will come out from the 4 bidders tomorrow. So we will have to see what they finally decide based on this on the release that's come through.
All right, Ekta, thanks a lot for that. 4 a.m. is when the company reported its numbers. So did you not sleep?
No, I just woke up with a shock.
Okay.
23-page press release.
Oh, gosh. All right. Thanks a lot for that. Let's move on then. Ahead of the 1-year anniversary of the rollout of the GST, my colleague Timsi Jaipuria, she caught up with Vanaja Sarna, the head of the Central Board of Indirect Tax and Customs. She says that there is still scope to trim the list of goods under 28% GST bracket, adds that as revenue stabilizes, rate revision can wait.
The number in the 28% bracket has reduced hugely, and it's just about 50 items, which is not to say that there is no scope for correction or for making changes. It is definitely there. But I think with this passage of time, a lot has settled in the GST, including the rate regime. And when we set out to actually fix the rates, it was done on a revenue neutral rate system, which we moved a little away from to ensure that there was rationalization, that goods which need to be available for local consumption, for the common people, is kept in the lower bracket. So while I would say there is scope to move from 28% to the lower level, I don't think it needs to be done too much in a hurry, because all of this also involves a certain amount of revenue loss. I think that is something as a revenue department we need to always keep in view while looking at rate changes, but that is not to say there's no scope. In fact, there is scope for looking at these. The question is of the timing.
Do you think the next GST Council would be the right time to approach the Council at least for a few items for this correction, or maybe a view to take whether it is the right time to move to the lower bracket, especially when it comes to cement, paint, etc.?
As you know, the next meeting is still a little while away, about 3 weeks away. So the agenda is still being finalized. Whether it should be discussed, yes, certainly as a matter of discussion, the Council may like to take a view on the need to reduce rates. But as I said, it has revenue implications, so it has to be looked holistically. Firstly. Secondly, I think revenue itself is just stabilizing. Perhaps rather than doing it too early, it's better to wait for a few months and look at how revenue is doing in this financial year before rushing in to make any changes.